What's up, everyone? Welcome to the daily macro update for Wednesday, January 7th. We got one of the most important coincident market indicators today, which is the ISM manufacturing PMI. This is the closest that you can possibly get to a real time GDP or growth indicator, only because the United States market is mostly a service based market, not necessarily a goods based market, although manufacturing and goods are very important and oftentimes a leading indicator of even the services index. We got that on Monday. If you want to check out Monday's live stream, you can do that. But taking a look at this today, I mean, this is really one of our team's most looked at indicators. And so it's a pretty big deal because it did confirm something that the bond market has been indicating for the last few months, which is, ever since the beginning of November slash end of October, the yield curve has been doing what's called a bull steepening, meaning that that's typically an indicator of accelerating growth or accelerating inflation. But in this case, with other indicators suggesting inflation is coming down, that led us to believe that growth was going to accelerate. And now we are finally getting some confirmation of that with the ISM Services PMI coming in at its highest print since October of 2024. And so, as you can see from the lows back in September of 2025, this has had a large 3 month acceleration. And so, yeah, I mean, this is right on line with what we were talking about beforehand with growth accelerating. Now, what's interesting is that when you take a look at the different components of the ISM Services PMI, you can also see that new orders accelerated to the highest point again since September of 2024. So, new orders is you can almost think of that as demand, right? And then also, two, the employment component reached its highest point since February of 2025. And this is really important too because services make up the majority of the jobs in the United States. This acceleration in employment is actually good news for the labor market. And then also, two, you're seeing a deceleration in prices. So the price index for the services PMI is its lowest since March of 2025. So these are all good news. Employment's improving, demand is improving, and prices are declining in terms of the aggregate economy. Now, this is the rate at which those things are accelerating or decelerating. And this is more of a news of a Goldilocks type of scenario. And I think that the market is still hyper fixated on rate cuts because obviously, if the market is having inflation come down while growth is accelerating, right? That soft landing type of Goldilocks. Well, then why would the Fed cut any more rates if the market is doing absolutely perfectly? In fact, what they want it to. Maybe the market can actually, or the economy can actually run at these higher interest rates. So if that's the case, then why loosen any further and risk inflation getting out of control as well? And so that's really what the futures market is pricing in when taking a look at the target rate probabilities for the January Fed meeting. It's now at 88.4% chance that they're going to remain paused or remain at the same target rate that they're at right now, which is between 350 and 375 basis points, or 3.5% to 3.75%. Basis points sound a little cooler, right? But this is the highest that we've seen for this range. And then also too, this has pushed out a lot of the projected rate cuts for this year. Whereas just last week, it was projecting that the first rate cut, 25 basis points, was going to be in April of this year. Now that's pushed down to June, the June print. So we might not even get a single 25 basis point cut until the summertime. But there's other economists such as Jim Bianco, who he's a great commentator. I would highly recommend you guys check him out. Jim Bianco is suggesting that we may not get any rate cuts in 2026. And that would be going back to the higher for longer phase three. because we've already been in two higher for longer regimes, right? One was when they stopped raising interest rates, and then they cut interest rates again in September of 2024, and then they paused in January of 2025 and didn't cut rates again until September of that year, right? And so it seems like the Fed is doing this strategic type of like lowering and then pausing for several months and just seeing where that neutral rate is actually maintained. And from what it looks like here in the futures market, it seems like that neutral rate might be between, that 3% to 3.25%. And so really we're only 50 basis points off from the neutral rate. Why would they start aggressively cutting rates right now when we're just barely above where they think is neutral? And again, the neutral rate is something that's made up. And yeah, the real thing that you have to take a look at is real interest rates. And that's kind of where it dictates where they want to hold that longer term rate. And so, yeah, what's interesting is that when taking a look at the real time inflation nowcast by the Cleveland Fed, they have CPI for January coming all the way down to 2.24%, which is pretty interesting. I know that last month we received a pretty surprising downside announcement from the CPI, even though it was technically an incomplete report. That went down to 2.6%, but they're saying that that trend is going to continue. And so, what we could see actually this year is a pretty strong rebound in a lot of the things that have been doing well since 2023. And so, that's part of the reason why our team was looking at, or not looking at, we actually did go bullish on things like Bitcoin, Ethereum, XRP, small caps, financials, a lot of these things that are actually doing well and being the uh, uh, beneficiary of this capital rotation from these large tech stocks into more cyclical and kind of defensive. Um, but it's not a matter of which thing, or it's not a matter of can I make money in this markets? You can. You just have to be looking for like this type of rotation. Which things are going to be bullish during this period? And that's what macro does very well, is it points you in the direction of those things. Now, what's interesting too is taking a look at some of the other metrics for today. We also received the ADP jobs number, which this isn't the official jobs number from the government. That actually comes out on Friday. This is a separate private measurement, but still it's widely looked at. And that actually saw an increase of 41,000 jobs in December, following a revised $29,000 loss, or not dollar, 29,000 job loss. And so you can see that here. Now, if I zoom out, though, what's really interesting is that you can see this huge deceleration in this average employment level, right? You had it pretty chunky over here, and then it's suddenly just dropped off over the past year or so. And we've talked about this beforehand with the labor market, and it's still up for debate. A lot of hawks on the Fed are saying, like, hey, this is the new normal for the labor market because of the large structural change with jobs and the supply and demand of workers right now. And then you have the other side of the Fed, the doves, being like, oh my gosh, the labor market is imploding. We need to cut rates like crazy. And, after looking at what the market has been pricing in and how it's been acting, I think it's actually taking the side of the hawks, saying that, hey, even though we're getting some of these lower numbers on average, I think it is, correctly pricing in this structural change in the labor market where, yes, supply is low, but also demand is low. And this is a combination of factors which we've gone into before. But just to highlight, you have the combination of, net zero immigration. You also have boomers retiring in a large amount, right? I think they've now entered mostly into their 70s. So they are way past, I guess, the quote unquote working age, at least for them. For our generation, we're going to be working till we are 120 years old in order to, keep on, maybe 150 years old, just to make sure that we can keep paying for things. And then our grandchildren are going to have to work until they're 200. So, but the boomers are able to retire around this age. And so as this retirement happens, it's shrinking that supply pool at the same time with immigration. And then also too, in terms of demand and this technological innovation from AI, a lot of these entry level jobs are being, kind of priced out by this technological innovation. And so a lot of these huge firms are no longer hiring as much. So all these combination of factors are contributing to this structural change in the labor market, and that, as well as a declining birth rate, you have a huge problem actually in the medium to long term. And so this could cause a little bit of a boost in the markets based on this, but there is no running from this large demographic problem that we have in the United States. And the saying goes, demographics is destiny. And if we don't fix this population problem, then we're going to have some real tough times ahead with sustaining any type of actual growth. And that's part of the reason why you're having this fake, growth right now and kind of fake demand is because, the government is spending a ton of money. They are right now, the deficit to GDP ratio is the highest since like World War II. And a lot of this government spending is actually propping up a lot of the growth numbers, right? Um, and both sides of the political aisle have their specific solutions when it comes to this demographic problem. The Democrats historically seem to be for open borders and trying to just, increase immigration because the native population is declining. And then the other side is saying, we should close the borders completely, but we should just make productivity increase instead of trying to, fix the birth rate. Both options, I don't think, tackle the actual issue, which is that native born populations are just not, they're not solving the underlying root cause of the issue, which is that the cost to live and all these different things are getting just out of reach for most Americans. That the middle class is being eroded. And so both sides of the aisle are just trying to slap on band-aids and kind of throw Hail Marys instead of fixing the underlying problem. And that's, part of the issue with the 4-year cycle and thinking short term and not long term with the political dynamics on policy. But that aside, though, can't really control what the representatives do on a monthly basis. But as I always say, what we can do is control our portfolios, and that's really what this channel is all about. So yeah, and then also job openings also had a large decline here. So yeah, I think this was the lowest level since September of 2024, which I think when going back further than that, that was the lowest since January of 2021, nearly December of 2022. So yeah, job openings continue to decline, showcasing that we did have a large bubble from the pandemic. So, maybe this is just part of the normalization period, but strong growth, recovering or stabilized labor market, inflation coming down. That's not really promoting rate cuts. That's kind of the story that's happening right now. But taking a look at the markets here, we have the US dollar, which has been having a pretty decent rebound here. It still remains in bearish trend, but if it does end up closing above, 99 or in the 99s, that'll take it to neutral for sure, which at that point, we want to continue to see which types of assets are positively or negatively correlated to the US dollar. Looking at this on a 30-day rolling correlation basis, we have base metals and gold, silver, all those are negatively correlated, but having a little bit of a bump, but still pretty much negatively correlated. What you have positively correlated to the US dollar, surprisingly, is Bitcoin. Now it's not incredibly positively correlated, but it is more positively correlated than, say, the S&P 500. So, yeah, that is definitely interesting. But when we want to zoom in on this, we can actually go to the 15-day to take a look at a more immediate term move here. And so as you can see, you're seeing a large lift in positive correlation to the US dollar, or at least going neutral, right? So like, for example, on a more, zooming in basis, we can see that base metals, gold, silver, platinum, palladium have gone from very negatively correlated to the dollar just 1 week ago to now they're pretty much neutral. So, even though on a rolling 30-day basis, it's mostly negative, when zooming in, I don't think that the dollar continuing higher will be too much of a detriment to some of these things that have been continuously going up. And what's really interesting is that on this 15-day basis, the Bitcoin or the dollar and Bitcoin, the Bitcoin, the dollar and Bitcoin are pretty positively correlated. So that is definitely interesting there. It is, though, at the top end of the trading range. So I mean, yeah, that's something to take note of. I was buying some Bitcoin today, actually, as well as some other things. For those who are in our macro investing community, you guys saw that earlier today, and we'll see if Bitcoin's able to hold trend here. um, I know that it did have a slight correction, right? Let me see. Yes, I mean it's still remaining in bullish trend though. So let's take a look at the volume from today. Yeah, nice little decelerating volume on a price drop. That's nice. It's a nice buy opportunity right there for Bitcoin, Ethereum, Solana, XRP. Yeah. Let's take a look at the S&P 500 here with the SPY. The market just closed 3 minutes ago. Taking a look at the trading range zone, it's still hovering near the top end of the trading range, and it's having a little bit of a decelerating volume while it's getting close to this. So you had a pretty decent selling opportunity today. Um, Seeing that volume has been declining a little bit. Volatility is still nice and stable. Uh, but over the past 2 days, you've had a pretty decent selling opportunity. This is all happening at the same time while volatility has been rising a little bit, but nothing too crazy. And then yeah, I wouldn't be surprised if we did have maybe a slight pop up in volatility, which would provide more of a buying opportunity on those bullish trends that we've been talking about. Platinum, silver, copper, all of which are just, being or having a little bit of a rejection from the top end of the trading range. This has to happen. So, for those people that were selling some the past couple days, you had a little bit of a buying opportunity today if you wanted to add back to some of these base metals. But yeah, what's interesting is that you are continuing to see a little bit of a capital shift from a lot of those Mag 7 stocks into a more broadening, into the more of the broad market, right? So, out of all the sectors, though, the largest mover was healthcare. Surprisingly, everything else was down. Tech, discretionary, communications, energy, financials. Financials is having um, a nice little price drop. Might start adding to that tomorrow, as well as some of our select single stocks within the financial sector that we like. But yeah, industrials, materials, all of which still are just having a nice little correction here from the top end of the range. Taking a look at the yield curve, having a little bit of a flattening over the past couple days, but these things can't go up in a straight line. Um, what was I just looking up? If you wanted to be, let me see something here. I was just looking this up. Man, I forget which ticker I just had up here. But if you wanted to be long, let me see if I have it up. If you want to be long this steepening yield curve, um, there is a specific ETF that my team and I like. Where'd it go? Maybe someone in the chat can look it up for me. I just had it here a second ago. Maybe I'll be able to look it up here in a little bit. Here we go. STPU. That's it. Yeah. So this specifically is the 10-year, 2-year ETF, steepener ETF. Yeah. So if you want to be long this yield curve, there's this one right here. I want to add this actually. Oops, wrong one. There we go. Okay, we can go ahead and get into some questions here. Appreciate everyone for joining. Good afternoon from Lakeland, Florida. All right, cool. Lakeland, up in near Orlando, I believe. This must have been from earlier. In other words, we either need to live longer, as you said, or maybe robots will fill the gap when the time comes. Yeah, exactly. So, as medical technology advances, they'll probably want to keep us alive for another 100 years or so, just so that we can continue to pay taxes, since the population is shrinking. Gang, don't make me blush, man. All right, don't you do that to me live on TV here. Thoughts on UAMY, rare earth metals? Hmm. I'm unfamiliar with this specific company, so I mean, I would have to look it up. $1 billion market cap. That's a little bit small for my taste. The lowest I'll go is around like 5 billion. I'm pretty conservative when it comes to these things, but yeah, I mean, I'd like to see it come up a little bit more. I do like how it's broken out, though. I guess I would say this is a bullish trend. Mm, yeah, this would be considered a bullish trend. Although I would want volatility to start to come down a little bit more, but yeah, I mean, it just seems like a small stock. I'm not familiar with it, but Amazon, Palantir, Google remained positive today, but Meta had a big drop. Wondering, it is bear trend. Meta, yeah, I think after today, it did go back to bearish trend. Um, Actually, it's probably just remaining neutral for now. And when something is neutral in our model, it's not a buy or sell. It's kind of just like a wait and watch type of thing. It is interesting though how with the decline in volatility, you didn't really get a pop in this one. So I mean, that isn't necessarily something that would be causing me to want to put this on a list of buys. But something to definitely keep watch of. But yeah, there's better things to own than Meta, that's for sure. Palantir, I haven't really looked that one up in a little bit. Yeah, this one's pretty much just been going sideways as well. It's had a pretty rough last week or so. So yeah, something like this. Again, there's better things to own. Google, on the other hand, that's a lot different looking chart. It's near the top end of the trading range though, on higher volume, which is good. But this is a way better chart than both Amazon, Palantir, or Meta. So Amazon is in bullish trend actually. Meta had a negative lawsuit news today. Okay. Well, I mean, It hasn't been on a radar to buy it for a long time anyway. There's been better things. Can you bring up the Fed balance sheet? It had a huge increase in purchased assets. Wasn't it supposed to stay flat? People on Twitter are saying full QE is back. Yeah, I mean that's what they've been saying for a while, ever since they ended QT. But it's not technically QE in a sense that QE is when they just completely flood the market with liquidity and they rapidly expand their balance sheet. Whereas what they're doing right now is they're trying to just maintain ample reserve levels. So, you know, the analogy that I give with the bathtub, right? So the bathtub is like the financial markets. Um, the water in the bathtub is liquidity from the Fed. And when they're doing QE, full blown QE, that's because reserve balances are really low, right? The water level is low and they're trying to get it back up. Whereas right now, it went from abundant and it drained down to ample. And so the water level is just right. And they're just trying to maintain it there, you know? And, in order to maintain that water level, if there's a drain open, is you gotta keep adding, right? So yeah, they're just simply maintaining ample reserves. They're not necessarily um, doing full blown QE at this point. So it is a little bit different. What makes people get confused is that they are, technically adding assets to their balance sheet, but also you have to think about the quality of assets that they're adding are these short duration bills that pretty much expire right away, right? So they have to roll that over. They are not buying long duration bonds, right? So they're buying short duration bills. But let me see if I can bring up if I can bring that up real quick here. All right. Yep. So yeah, it looks like they have added a little bit to their balance sheet here, but I mean, like, look at this. You see this huge move? That's QE. This little thing right here, I'll zoom in. Is that QE? No. It's kind of funny when you look at this chart, right? I forget that meme where it's like, something barely moves and it's the guy like pointing at it. Like I told you. But yeah, they're just trying to maintain ample reserve levels. It's not full blown QE. Any robotics stocks I'm aware of? Nope, I'm not. How about you? Can I ask your thoughts on SERV? I can bring it up, but I don't know. Again, I don't know anything about the company, so I'll just tell you if it's. Let's see. Top end of the trading range. Did make this. Did make this lower high right here. Did it make new local? Did it break through that point? Yeah, I'm not sure. I would need to see some more work from this, but again, I don't know anything about this company. $1 billion market cap, so it's too small for my taste anyway. Um, yeah, volatility is a little high, but that's kind of normal for a lot of these smaller ones. But yeah, I mean, just looking at this right now, there are better things to own, but it could move a lot. Doesn't really look like it's done much in the last year or so. Yeah, I mean, it's like, why own something that's just going to go sideways for a little bit? Wait for a breakout and a confirmation of a bullish trend. Can you check PANW Sure. Yeah, this is actually, let me see. No, this remains on a bearish trend. So yeah, probably, I mean, if you bought some and you're up, great time to great time to get out of it. Let's go ahead and take a look at some of the questions here from TikTok. Do you think TLT is going to go up, or do I think long duration rates are going to go down as rates drop due to a weak economy? Uh, I don't think so because we're seeing a more strong economy right now from a lot of the leading indicators. Just scrolling through here. All right. Okay, well, we're approaching the time to get off here. So I appreciate everyone for joining. As always, if you guys would like to learn and incorporate more macroeconomics into your process, you can go to our website, which is just macro-optics.com, or you can just go to the link below. You can check out our two services. Um, you can look at those there. But yeah, I'm gonna add here from now on the homepage. We're just going to post the current trend status of the S&P 500, whether our model is bullish, neutral, or bearish on it. So if you just wanted to bookmark our website and just check in on it, and we're gonna update this in every single morning if it, or we're gonna look to see if it's changed every single morning, and if it does, we'll update it on here. And then of course as well, you guys know that the background color of my bookshelves is also the current trend of the S&P 500 as well, which has remained green for quite some time. And look at that, we just got new all-time highs in the S&P 500. What do you guys say? I'm just joking around. I don't take any credit for this because I'm just following my model and my process. Like, um, we don't make calls here. All we do is just follow what the math is saying. So don't thank me, thank the math. I'm just the messenger. And yeah, I appreciate everyone for joining. Oh, last question here. Would you say QBTS looks like it's finally turning around, higher highs and lows? Let me see. QBTS. Um, yeah, this is kind of interesting. I mean, you're definitely correct. It has made a series of higher highs and higher lows. Yeah, I would say this is actually a bullish trend. Even though I'm still working on this trend classification model there. Yeah, I mean, $10 billion market cap. Yeah, I mean, something like D-Wave. Um, Now would I be buying it here? Probably not. It's still kind of near the top end of the trading range in our model. But yeah, maybe I'll take a shot of this if we have another down day. That's pretty interesting. Good call out though. Good call out. Okay, we're going to go ahead and end it there. I appreciate everyone for joining. We are going to be back at it here tomorrow at 3:45 p.m. So I'll catch you then. Good luck out there, and I will catch you tomorrow. Bye, everyone.